All right. If you're just joining us, this is the Creative Finance Collective. We've got a small group here. If you're new or have never watched the collective, the purpose of the collective is a get together, a membership, a mastermind of lawyers and professionals in the space of creative finance. And we talk about creative finance things going on in the creative finance world from a variety of different spaces. But the main thing that we want to do, and the main thing that we're here to do, is to take your questions. So if you have questions about things relating to creative finance, and heck, I mean, if you have stuff related to real estate investing, and you want to hear a lawyer's take, we're happy to discuss that as well. I'm Andy Fowler, an attorney here in Scottsdale, Arizona. Also, we have Sean St. Clair, an attorney in Arizona, who's here as well, and then Elizabeth Best, who will be coming on, is working on getting access to her camera and microphone. So if you have questions, make sure to post those. We're going to take those and talk a little bit of creative finance. Sean, how you been?
Oh man, I've been good. Yeah, things are
So,
good.
so I know you're an Arizona lawyer, but you're coming to us right now from Wisconsin. I'm curious, creative finance is pretty popular here in the West. And you've attended a few marketing and real estate kind of meetups in Wisconsin. Is it even a subject? Um, is it even a subject in Wisconsin? Do they even know what's going on? Is it something on people's radar?
Yeah, they know what's going on, but I would say that it's not as popular of an investment strategy as in Arizona, and we don't see, or in my experience, limited experience, meeting with real estate investors up here and getting to know them that they're doing a lot of subject to transactions. There are some that know how to do it and do it, but it's not definitely as popular up here as it is down in Arizona. Arizona, Texas, Florida,
Florida, yeah.
Georgia. That's kind of the mecca of subject to. There's other parts, some East Coast, Northeast states, and other parts of the country, but really, California's a big one too.
Yeah.
There's a lot of subto in California, but for some reason, I don't know if it's because I found Wisconsin to be more of a stable, market with not like rapid, appreciation or depreciation. It just kind of, gradually goes up versus some of these other states. You're seeing a lot of, this on a, you know, kind of a scheduled base, not a schedule, but you know, over time, that cycles, you see cycles of appreciation and depreciation. And, right now we're seeing a lot of appreciation, not a lot. There's some places that are stagnant, but we're still seeing appreciation due to a lack of, inventory supply of houses on the market.
So is are there any legal barriers that you're aware of? I know you're not licensed in Wisconsin, but having been there a little bit, are
Yeah,
there any
I
things
don't
that
think
kind of
there
make it
are.
harder?
No, there's people that are doing it and are familiar with it, and there aren't any legal barriers. It's just I don't know. I don't know. It just doesn't seem to be a big investment strategy. In fact, a bigger investment strategy seems to be getting like hard money lending to purchase properties, and then like refinancing. That's the other thing with Wisconsin, which I actually appreciate. It's there's a lot more relationship business that happens in my view up here. A lot more smaller community banks, those types of things that you know you you can go and purchase a property with hard money and then you know quickly refinance out of it with a more conventional type financing transaction.
If you're just now joining us and watching, this is the Creative Finance Collective. So we're talking about all things relating to creative finance, real estate investing, and the law relating to those things. So the important thing for you, the listener, usually we've got 5 to 6 lawyers that get together that work through some of these issues. But the main thing that we try to do is be available for an hour to take questions relating to creative finance issues that real estate investors are running into. So if you've got a question pertaining to creative finance, real estate investing, go ahead and post it. We'd love to address it and answer it as best we can. Sean, in Wisconsin, is it a judicial foreclosure state or a non-judicial foreclosure state?
Judicial foreclosure.
Okay, so if you're dealing with that, you need to plan on being in the courts.
Yeah. So if you're a seller and you sell on a wrap, you would definitely have to, prepare to be in the court system to foreclose. So yeah, it's just,
So you're dealing more with like redemption rights there than you are like reinstatement rights here with deeds of trust.
correct. Yeah, that's exactly right. Yeah.
Which doesn't necessarily pose any difficulty to a creative finance transaction. It's just knowing what the nature of it is and what you got to deal with, right?
Yeah, but if I'm a seller, I'm not sure I'm as, thrilled about the transaction because of the nature of having to, judicially foreclose and then have redemption rights and things like that. So I don't know. Like I said, it's being done. It's just not as much volume as say down in Arizona and some of the other states.
What about closing the transaction? Are they similar to Arizona where you can close with a title office?
Yeah. Mm-hmm. In fact, we've purchased few pieces of real estate up here. You just close with a title office. You don't have to go through a closing attorney. And it was pretty painless. Very similar to Arizona, they issue a commitment for title insurance and do a closing statement and all that good stuff. So yeah, it's pretty straightforward.
Interesting. So
go ahead.
Go ahead.
Well, I wanted to kind of throw something out there and see what your thoughts are. So one of the things that I've been kind of pondering is the idea of somebody buying a property subject to, for themselves, and then living there 2 years and then turning it into a rental. And then from there, figuring out, okay, you have a single individual has a $250,000 capital gain exemption, and then a married couple has 500. And the rule is that you have to have lived there 2 out of the last 5 years. So if you live there for 2 years, you can then rent it for 2.5 years, or up to 3 years. But to get the exemption, you would have to sell the property or do some form of transfer of the property prior to the expiration of that, final 3rd year that you've been renting it.
Right.
But you've kind of course, become accustomed maybe to the cash flow. One of the things that I think is a good exit strategy, I'm not sure a lot of people are really thinking about it in this way. And of course, you can only do it for one house at a time, but would be to figure a way to cash out as much of that 500,000 as you can, pocket that cash free, and then sell the remaining amount on terms. So let's say your loan is that you purchase subject to is at 3%. Well, you could make a second position loan, or I guess it would be a third because you still have your subject to loan out there, but you can make a loan to the buyer who purchases it subject to on terms to you, where you basically offer the loan at 5% or 6%, and then you got that cash flow coming in every month. I mean, I'm not sure that a lot of people are doing that. Or let's even take a step back and let's talk about just a seller who let's say I have my residence that has, a 3% loan, for example.
Right.
And I decide, okay, I'm going to turn that into a rental. I'm going to rent it for 2.5 years. And then if I can sell it to somebody, and maybe that person even, they want a low interest rate, but they have a lot of equity in their current house, but they don't want to buy a house at, 7% interest. I could, in theory, go and make a 5% loan, cash out, I don't know, close to $500,000, and then get the cash flow every month coming in on, selling the remaining amount on terms, if that makes sense. Now, that only works in states where you have properties, worth a lot, right?
Right.
But in Arizona, it works. If you have a house that's worth $800,000 and you have a $300,000 or $400,000 loan, I mean, you could cash out a decent amount, then carry the remaining amount on terms, and still put money in your pocket every month. So I don't know, something to think about. I don't think a lot of people are doing that, and I
well,
don't know why.
the primary goal being the tax advantage, right? Is that?
Yeah, you can sell it tax free and pocket a bunch of cash, put a bunch of cash in your pocket tax free, and still have the cash flow that you had when it was a rental.
Right. Yeah. Yeah, I don't know. Well, nobody's talking about it. I don't know how many people are doing it, but yeah, nobody's talking about it. You would think more people would want to do it for the other reason too, especially if you're going to hold on to it for a little bit. You would want to potentially convert it to a rental anyway in order to get rental income if you were going to increase your income and, try to make yourself eligible for a future, other conventional loan, because you got to be able to qualify for that. So I would think a lot of
Right.
people would be thinking rental potentially anyway.
Yeah.
Have you run into anybody who, I know you haven't seen it a lot, but anybody who's actually done it? I guess we haven't been really going down that road long enough to know.
No, we've seen some, sellers who are sophisticated and they decide, oh well, I can do okay selling this property for, a little bit over fair market value, as long as I'm willing to carry terms. Um, and then they do generally require some form of cash, payment or cash out, payment as part of the purchase. So I don't know. It just depends what they're looking to do. But I think a lot of times taking advantage of the capital gains, I think is kind of overlooked. Taking advantage of the capital gains exemption is being overlooked quite a bit.
Well, it's a big amount, right? It's no tax, right? That's the exemption.
That's right. No tax.
Versus, I guess a long-term capital gain would be about 20% typically.
Right.
So even compared to that, that's a significant amount of capital, right? Yeah. So,
Right.
Are there any limitations to it other than the IRS, the IRS limitations we know of, which is got to live there 2 out of the last years? I'm not aware of any other limitation. There's certainly no limitation that can't apply to like some sort of sub-2 deal.
Right. No, no.
Because title's being conveyed to you, so you're an owner.
Right. Yeah.
That's interesting.
Yeah, you just have to live there, but yeah, it's interesting. And it's 2 out of the last 5 years. So in theory, you could live there for 6 months, live somewhere else for 6 months. In theory, you could, over that 5-year period, convert, multiple homes into, a capital gains exemption.
Right. Well, part of me thinks that we're just still too early in the cycle to have run into people who have done this or done this yet, because, we're only, I don't know, creative. not to creative finance, or we've talked about this, that seller financing is new or anything. It's not new, but the hype and the popularity of it is, we're only, when did that start? Really, really start? 19, 20, 21. You know,
Yeah.
the problem
Yeah.
with inflation's only about a year and a half, 2 years old, a real problem with it. So, I don't know, maybe we're coming up close to the first initial 2-year mark where you would have lived in it 2 out of the last, uh, 2 years out of the last 5. That's interesting. Um,
Yeah. Yeah. It'll be interesting. I mean, at some point, I mean, with this housing market, I just wonder, I just wonder at some point, I think the creative stuff's going to have to be more commonplace just to see movement in the market.
yeah, for
I
su
mean, I mean, well, we see it in Arizona. Like houses are still selling. There's low inventory, and people are able to afford them. But I look at the numbers, and you probably look at them too, and be like, "Man, I'd be hard pressed to afford my house at the interest rates that are out there." And for its value right now. You know what I mean?
Oh, yeah, it's hard to, frankly, it's hard to imagine not doing a creative finance transaction right now. I don't know how people, I keep hearing about these new kids in the market buying their first house at like 600,000 at 7 or 8% with a $4,500 monthly monthly payment. I'm like, I've never paid that for a home in my entire life.
No, I
It's
mean, yeah, it's insane. And
and it's a single family home.
right.
Now here's an interesting question. I'm sure, we don't have the answer to this, but the because of these market conditions, while interest rates have risen, and because on these 3 and 4% mortgages, that's impacted price because we just don't have the sellers. They don't wanna sell, they wanna sit on what they have. Understandable. So that's propped up price. But what happens if price falls? Not what happens economically. I know what happens to the market there, but is creative financing still have the same popularity with falling prices, but still higher interest rates?
I think so. Yeah.
Yeah, you don't think that dynamic changes?
No, in fact, you know, there were some people that were doing the subject to stuff, and I don't know that we fully appreciated it or you know, understood it back in '08, '09, '10, and there
Yeah.
weren't nearly as many people out there doing it. But if and I don't know that the market's going to turn this direction because it would be substantial depreciation. But if all of a sudden you started seeing like short sales on the market,
Yeah.
why would you ever short sell your house? I mean, if I'm if I'm an investor, well, have a little bit, but if I were active, really active as an investor, I would I would be all over short sales and being like, hey, look, let me just take over your loan. I'll pay you, an amount. I'll give you money to take over your loan, to bring it current, to improve your credit, and eventually, your credit's going to be improved. We're going to pay this thing off, and you're getting money in your pocket.
Well,
Uh,
that's
you know,
interesting. Maybe creative finance is going to be, or could be, the new short sale. The new thing that
yes,
basically stops a
right.
the foreclosures like you would normally see, right?
I think it would, yeah,
I
because I
I could
think,
see it.
yeah, the popularity's, people are and investors who are savvy enough, they know, okay, look, cash flow is a bonus, but being able to basically take over somebody's 3% mortgage, to own the house, to have the depreciation associated with it, to have the, already uh, in place amortization where the loan's now like only 20 years away from being paid off versus 30. And you pay more principal as time goes on. So like, why wouldn't you go to somebody trying to sell on a short sale and be like, okay, tell you what, now if it needs like, like if it's so there are some short sales where people thought they would remodel their house, got it down to the studs, and then, basically ran out of resources. Like that might be something where you're like, yeah, just let the bank deal with that. But I mean, you get a house that just needs a little bit of, TLC and, it's ready to go. Like, man, why wouldn't you take that over? And even if the value is less than the loan, it's going to come back. The market's going to come back.
Yeah, that is a scenario where we would see states that have the foreclosure rescue laws come way more into play.
Oh yeah.
I could definitely see in that scenario too, where you get decreasing real estate prices and more distressed properties, and investors just jumping at the opportunity to get better deals with better interest rates. I could see, I don't know, I don't wanna say a contagion, but, when one state regulates, and it's a new thing becomes a hot thing, the regulators love to jump on it. So you could kind of almost see a bunch of states, jump in and do what, like, the Colorados of the world did with the
Right.
foreclosure rescue.
Yeah. Hey, it looks like we have a question here.
Yeah, you wanna read it?
Yeah, so it says on creative deals, why are some closing attorneys willing to draft deeds of trust, mortgages, and promissory notes, but not record them for their clients? So I'm not sure what this is referring to. So a couple of things. Number one, FHA loans, VA loans, the closing attorney may be worried that they're going to, if they record it and they're shown as the one that records it, that the FHA will, like blacklist them and
Just like
not
any
do
other
business
title
with them.
company.
Right. And not do business with them anymore. The other thing is title companies and closing attorneys have been, and they don't do it as much anymore because they have been sued for courtesy recordings, where, they recorded something, it turned out not to be, an accurate document. It was maybe forged or whatever, and they were just doing it as a courtesy for one of their clients or whatnot. And then they end up getting in hot water over it. And so there are title companies, and I'm guessing closing attorneys, who won't do courtesy recordings anymore. They won't record that way. So that is also a possibility.
Well, could this also be, I kind of, again, we don't know what state this question is coming from, but, in Arizona, lawyers don't close you've got title companies that do this. So there are circumstances where we might be hired to prepare the deed of trust or the note, but we would want the title company, we would send that over and we'd want the title company to record that. Sometimes the title company doesn't like to insure around stuff that isn't notarized by their office right?
Correct. That's
You know?
also right. Yeah.
Yeah, so sometimes it could be, I don't understand it in the context of where you're a lawyer closing state, you might be the one responsible for recording, but here, yeah, it's like, title companies, it's like if some other title company wasn't there for the notary or their notary didn't do it, in some places, they just don't like it and don't want to insure
Right.
around it, so it's like, well, okay, so we won't mess with that, just have the title company do it if you're getting a title insurance, so on and so forth.
Right. Yeah. Yeah. It really just depends on the circumstance, but I don't know why they would prepare it and then not want to record it unless they just, are uneasy that they can't certify that, their notary or their approved notary signed off on it, and so they're uncomfortable recording it, and they don't want to expose themselves to any liability.
Yeah. Which kind of brings up another question. It's when we're talking about creative finance, it's pretty important that you have a title company that knows what the heck they're doing, right? That knows
Correct.
what to do with creative finance. And we've got some title companies that we've worked with and can refer, and that can change. But if you just run into a random title office, which can happen if you're not prepared for it, right? Because if you just, let's say you get in contact with a seller who's got a real estate agent, oftentimes that purchase contract already has built in some title company that the seller's agent, is friendly with, right? A lot of times
Right.
that's already worked in. If you're not thinking about that ahead of time, you might end up in a place that you don't want to be. How do you handle that, by the way? If you've got an investor, or how do you recommend handling that? You've got an investor who's looking for these deals, finds the real estate agent who's been listing the property for the seller in the conventional space. It's just not selling, and now they're taking calls from subto buyers. Is that something you encourage them to look at and try to deal with on the front end so they don't end up with a title company? I know you can always move title companies, but
Yeah. So, well, and so what's interesting is there's this federal law out there called RESPA, which basically states that the seller can never dictate the title insurance company. So it's not the escrow agent, it's the title insurance company that is going to be chosen by the buyer. And so now, normally what happens is the title company that you choose is also the one that brokers or obtains the policy. So let's kind of break this down. There's escrow services, there's title companies, and there's title insurers. Sometimes those are the same thing, but many times they're different. So here in Arizona, if you have, so-and-so title company or so-and-so, closing company or title agency or, but it doesn't say, it just talks about closing and title, but doesn't say insurance.
right.
Then they're not an insurer, that they are simply an escrow agent. Then you have your title insurance company. So if it says, so-and-so title insurance company, then they're an insurance company. Now, sometimes the insurance company also does the escrow. And so when you open, and I won't say the names, but they're the big players out there. We all know them. But you have these big title insurance companies, and you open escrow with the title insurance company. Well, they're doing the whole thing. They're doing the escrow and they're providing the title insurance. But if I go and open with so-and-so, title agency, they are only licensed to provide escrow services. They're licensed, actually, they're two different licenses. One's through the Arizona Department of Financial Institutions, and the other one is the insurance is through the Department of Insurance, Arizona Department of Insurance. They're two different licenses. So the title agency or the title company is only licensed to do escrow. However, they are able to bind and broker the insurance. So they have an arrangement with the insurance company that says, hey, I can act as your agent. And if I do, I get, a piece of the action, right? So the insurance company gives them a portion of the premium to serve in that agency capacity. So when you look at like your title commitment, you might open title with this escrow agent over here, this title company, but then you look at the title commitment and it's issued by so-and-so title insurance company, and then it's signed by the branch manager or the escrow agent as, agent for that title insurance company.
Right.
So I say all that to say there's two different products that people don't realize it, but there's two different products that you are purchasing when you close escrow. The first is the escrow agent services. They're the ones that prepare all the documents, the settlement statement, they, track the money, handle the money, blah, 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 blah. Then there's your title insurance, which is a whole different product. And they're the ones that provide insurance to the buyer or the lender, which basically says your title is good, subject to all these different exceptions, but your title is good. They insure title. Well, you could, in theory, and I've seen it actually done, you can escrow agent over here provide just services, or this title company provide just escrow services, while you go and have another either title company broker, or you go directly to the title insurance company and have them insure the transaction. And they're both involved in the transaction. Now, the escrow company or the title company that's just doing the escrow services hates that because they make all their money on the insurance side. They don't want to do that because escrow is kind of like, they don't make a lot, if anything, right, on the escrow. They make it on the title insurance premiums. So you could, and I've had cases and situations where lenders when I worked at a large firm in Phoenix, we did some lender representation. Those lenders insisted on using a very specific insurance company who didn't do title here in Arizona. And so they had to go to a different title company and do the escrow. So when the lender did what we call REO, real estate owned, where they purchased it at the trustee sale. So it was, during our distressed time, and the lender ended up being the owner of the property. When they would do a disposition or a sale, they would say, well, I want this title insurance company. And they could insure title. They just didn't offer escrow services. So you had to go to a different escrow company and just say, well, okay, you're going to do the escrow, you're going to do the insurance. And those two work together to close the transaction. So what could a buyer, so getting back to this, what could an investor do? An investor has a legal right as a buyer to say, okay, I'll go with your recommended title company to do the escrow, because you can, as the seller, you have a right to dictate that. It's a negotiated term. But you don't have the right to dictate who's going to do the insurance. I want to use my title company to issue the insurance product. That generally will sway the seller's agent and the seller's title, the preferred title company of the seller's agent, say, let's just let that title company do it all. Like, we don't want to do that because we don't have as much of the upside, type of thing.
Right.
So
because because the escrow side of it's just the rogue preparing. If you ever look at it as a settlement statement and broke down the costs and fees associated with the escrow side of it, that's the small piece. Not the insurance premiums, the bigger piece.
Right. It's not a lot. It's a lot of work for not a lot of payment.
in fact, it's probably most likely a lot of the escrow services are probably priced in such a way in order to try to get the title insurance part of it. It's like, right, we'll just do this for this small fee in hopes to get the bigger fee.
Yes, that's exactly right. Yes, yeah, that's exactly right. So, and we saw this during the short sale days, where buyers agents would, want to use their title companies. And so they would basically say, and of course, sellers agents, because of the nature of the short sale, they would be like, oh, well, we want to use this title company. There was always this fight, and, the buyer would end up saying, oh, that's a RESPA violation. Well, no, it's not. It's a RESPA violation to make you choose the insurance company, but you can open escrow with who, that's a negotiated term. So, but as a buyer, if you're aware of that, you can say, okay, I'll use your company for the escrow and I'm going to use this over here. And if they push back and the seller and the seller's agent pushes back on that, that's a RESPA violation, and something that should be pointed out at that point.
Yeah. If you're just now joining us, this is the Creative Finance Collective. We're talking about all things related to creative financing and real estate law. But if you have a question, we're taking questions throughout the entire hour. And for the last little bit, we've been talking about title companies, which was spurred on by a question from a listener, and talking about the importance, if you're going to get into creative finance transactions, the importance of finding a title company that knows what the heck they're doing with respect to this. Sean, what do you think? I mean, maybe it's gotten better, but in your experience, at least in Arizona, are there really more than a handful or a few title companies that are really up with creative financing?
I think just a handful. I mean, I personally have two that I generally refer to. Outside of that, I mean, I know there's others that do it, and but outside of that, those are the two that I'm pretty comfortable with when I'm involved in a subject to transaction, recommending my clients to use. And so, but I know there's others out there. I just don't have the experience with them.
Yeah. Yeah, I would think over time more and more are going to have to get forced to be comfortable with the transaction. And
Yeah, and what I don't understand is I understand the FHA VA part, especially the FHA, because there are stories of title companies, basically not being allowed to do business with the FHA anymore, and that's a substantial, not a substantial, but it's a significant percentage of their business. So I understand that part of it, but on a conventional loan, I'm not sure I fully understand or appreciate the concerns of closing that transaction. I mean, you put the deed of trust or the existing loan, the loan that's going to remain, you put that as an exception on the title policy. The parties understand the exception, and if the transaction's papered correctly, I mean, what's the concern?
yeah,
I'm not aware of, and obviously these title companies are trying to avoid it ever happening, but I'm not aware of any title companies being, sued or dragged through the mud for closing subject to transactions on, conventional loans.
Yeah. Yeah, that would seem strange. I wanted to get your take on this. This is kind of just related to the market as a whole, not so much creative financing. But did you see the article about Zillow and what Zillow's doing?
Yeah,
with the 1% loans?
yeah.
Or
So
1% down payment, right?
Yeah, talk to me about that. Is Zillow providing the financing?
I guess. I think so. I don't know in what other capacity they'd be trying to sell that. Unless they're trying to sell their own homes that they owe and they're going to carry it, but then they would still be providing the financing, right?
Right, and that's the problem too. With Zillow, obviously they're a huge company, but they really they stopped buying real estate, so they're probably trying to unload the real estate that they bought. I don't think that that their venture into real estate is. I don't know. I don't want to say. I don't know why they're doing that. But
Well, they definitely did.
Stopped buying real estate. That's all I know.
Yeah. Well, and they definitely did get aggressive when the market was hot. I remember reviewing. I remember I got contacted and somebody just wanted me to review a purchase contract, and it was from Zillow. And I was like, But the first thing that went through my head is like, oh, holy cow, you're about to get hosed, right? This isn't Zillow just came in and just offered it. And the more I looked into it, and they're like, yeah, we talked with a realtor, and the realtor ran comps, and they're like, man, this is over what we're even seeing with comps. And I'm like, man, this sounds like a good deal. You probably should just do it. But Zillow was just running in, just buying everything. It didn't matter what the price. I think they basically got word that, the BlackRocks of the world and all the hedge funds were just going to own real estate, and let's just get in because the rental market's going to be good. But they so overpaid for so many things. So with this article, I don't know if they're trying to provide their own seller financing, or if Zillow has its own lender wing that loans, and they're just trying to spur buying. So they're offering
Yeah,
1% down loans. I don't know.
right. Well, obviously Dodd-Frank would prohibit them from doing any volume of seller financing without
Yeah,
involving
that's
a
true.
loan originator.
Yeah, so it's got to be
So
a
they would have, yeah, they probably have their own lender in place.
the flack that the article got was kind of an economic one, which is, boy, haven't we tried this with like, just basically almost, nothing down loans, giving, zero risk to, you give almost zero risk to a buyer in an economic environment with high interest rates. So it doesn't take near as much cash to come to the table, but the cost of this mortgage is probably going to be significant given real estate prices and interest rates.
Yeah.
Whether that creates some sort of future problem, I don't know.
Well, yeah, there's no margin, right? So the minute you see a small dip in the market and people want to move, their only option is subto or short sell, I guess. Now it used to be just short sell, right? And I don't know. I actually don't think it's a bad move by Zillow, because, and I'm not an economist by any means, but I just don't see how we're going to see a huge drop in the market when nobody's wanting to sell their homes.
Yeah, at this point with the 3 and 4% mortgages, you would have to have some economic event so big that forces people into selling. They need the liquidity of just selling, so they're a forced
Right.
seller. Like if they lose their job, right? Sometimes you don't get to make that choice if you don't have any money and you got to just do it, so you do it. But that hasn't
Well,
happened, and so long as we're left with the voluntary choice, of course we're going to take a 3%, 4% mortgage.
well, yeah, and that's the other thing is like if I have a bunch of debt, I mean, I don't say this lightly. I'm not a bankruptcy attorney, so I'm not never. I shouldn't even say this, but if you have a bunch of unsecured debt
Yeah.
out there and you have a 3% mortgage and you have equity and you have homestead, Arizona's homestead's $400,000.
Yeah. It's
I
true.
mean, let's just put it this way: bankruptcy attorneys may become busy. I
Right,
mean, why would you?
if you yeah, you can keep your home in bankruptcy.
Yes.
Yeah.
I mean, you can keep as long as the value of your home is not substantially over, the loan, plus if the equity in your home's not substantially over the $400,000 homestead, you get to keep your home. You get to keep your 3% interest rate. Like,
Yeah.
why? Yeah, I mean, it would make no sense. I mean, to sell your home to pay a bunch of unsecured debt and get rid of a 3% loan that's, like free money. Why? That makes no sense.
Yeah.
I mean, obviously but people do it. I mean, the bankruptcy courts at one point were packed. People are just filing left and right. And so, there's a certain stigma that comes with filing for bankruptcy, but financially, maybe it does make sense if that's what you're dealing with.
Yeah. Yeah, but
And
even if
that's the other thing. At 3 or 4%, I mean, let's face it. I kind of play around with door dashing at 3 or 4% on, for my house, say, in Arizona, and the mortgage I have against it because I bought it, a while back, and I think my loan's below that. I literally could DoorDash every day and pay my mortgage easily.
Well, what's the other thing that's interesting, I hadn't really thought about this before, but you made me think of this in the bankruptcy discussion. Let's say you don't even file bankruptcy, but you've got these other unsecured debts and you can't make that payment. Well, even if they come and get a judgment against you, your homestead's protected.
Right.
And okay, so let's just yesterday on the NREM podcast, you brought up efficient breach. So the idea of deciding when to breach a contract when it makes more economic sense to either honor the contract or to breach the contract. So, you play this out, okay, I've got car loans well, that's probably secured, but let's say credit card stuff, and I can't make the payment. Well, what you might have used to have done is sold the home, get all the equity out, and just pay all that stuff off. Well, versus not having to maybe take the credit hit, or for not just maybe, for sure the credit hit of being sued and having to resolve those kind of things. But that's no doubt stressful and it's costly and everything else. What do you think the cost is going to be to get into a new mortgage? Let's say you don't take any credit hit and you're able to flip your house and sell it and get out of that. You still got an 800 credit score and everything's great, but now I got to go buy a new house. And instead of my $300,000 mortgage at 3%, I've got to go get the same house for $600,000 at 7% or 8%.
Yeah. No, you would never be able to do it.
No, that math doesn't work.
No. And even if you downsized, you're still paying more for a much smaller house at a much higher interest rate than what you currently have. Why wouldn't you just stick with what you have? That's the other thing right now. Is another thing that's going on in the market, and is the price of insurance is going up because the price of construction is going up, and the price of having to rebuild your house and your home. I mean, it's gone up substantially, the price of materials or whatever. Well, that's also, and people have said, well, it's the COVID supply chain. Part of that is, but a lot of that right now is being supply driven. And the reason is because you wonder, like, why, where are people getting, with all the inflation, whatever, where are people getting the money to do, to hire these contractors, and why are they so busy and whatever? Well, the reason is because instead of selling their house, they're using their limited resources, or they're getting a small equity line or something like that, and they're going and remodeling their house because they can't afford to do anything else. People can't afford to, homeowners can't afford to do anything else. So they're going and they're remodeling. And so now all the contractors are busy, and there's limited supplies, and those are expensive. And so it's like the cycle that, honestly, until we start seeing some movement in the market and houses being put on the market and people being able to buy and sell, presumably creatively through like subject to or whatever, I think we're going to see kind of this, bottleneck of things that are causing prices within the housing industry and the construction industry to continue to go up, which now are affecting everything else, like insurance rates and things like that.
Yeah. Well, and if there's no economic incentive, which there isn't, I mean, you could see a scenario in the economy where a lot of other industries do drop off, but because there's no financial incentive or benefit to the seller to sell their home, that just continues to stay sticky, low supply. Basically, that's,
Right.
It's just supply and demand. If the supply stays low, there's not going to be movement in price.
Right.
Yeah, that is going to be interesting to watch. If you're just joining us, this is the Creative Finance Collective. We're taking questions for the hour on creative finance topic, real estate investing topics, and we're answering any legal questions that you have. We'll be here for another 9 minutes or so. So if you have a question, make sure to post it. That's what we're here for. We're here to, I mean, Sean and I like to talk to each other, so much so that we've been in business together for many years, but we don't like to talk to each other so much that we have to do it online. We're here for you to talk and answer questions that you might have. So if you have them, make sure to post them. Yeah, so it'll be interesting to see what the economy does. But you know, just thinking through that, it sure doesn't seem like we're going to see. Two things don't seem like they're going to change, which really bodes well for creative finance. If you love creative financing, housing prices don't really seem. They don't seem to. There doesn't seem to be the conditions that are going to make those plummet, and interest rates are probably going to be where they are for some time. I mean, to put this in perspective, we may be close to the point, and I say close, who knows? We may be close to the point where the Federal Reserve may pause what they're doing, which is to say they're not going to raise it anymore. But absent some giant credit event in the market that is like, you know, just scares the hell out of the Fed, the likelihood of them just suddenly going, oh yeah, we're going to go back to zero interest rates tomorrow. That's not happening. You know, that's not happening. It's taken us they've been raising rates for over a year now. It's taken us over a year just to get to the point where they're maybe slowing that down. And even if they taper that, we're going to be here for a while, I think.
Well, and that's the thing. Having these low interest rates were unprecedented. I mean, yeah. At least since I've been living and, you know, witnessing my parents buy and sell houses and kind of knowing what their interest rates were, knowing what the interest rates were when my wife and I first bought our house, when we bought another house, you know, the whole thing, you know, they were, when my wife and I first bought our house, I think we got a 6%, 6.5% interest rate. And we thought that was low. My parents thought that was low. And, you know, but the house wasn't very expensive. Yeah. And so 6% that we could manage because, you know, we're buying a $200,000 home or, you know, that type of thing. And then of course, when the Great Recession happened, it was like, well, how can we stimulate, you know, sales and get people, you know, buying houses and making so, you know, the values could go up. Well, you know, and of course there were other factors as well, but, you know, let's lower interest rates.
Right.
So you have these low interest rates for so long. And now I don't know that you're ever going to go back down to those. I just don't know. I mean, I don't, like you said, I don't see it happening. And so you have a finite amount of these that people are holding on to like it's, you know, the golden ticket and nobody wants to let it go.
It is the golden ticket.
It is. Yeah.
The American consumer is smart enough to know when they've got something sweet, don't let go of it.
Oh yeah. Don't let go of it. Like never let go of it. And people, and even it's even to the point where now some people are like, oh yeah, let's just unload it because we want the cash in our pocket. But other people are recognizing, well, if mom and dad pass away and they have this low interest rate, like, why would we ever sell the house?
Yeah. Well, you know, what's funny is the way you used to transfer wealth for basically a millennia, probably more than that. I mean, it was land. You know, that's where you always heard families, you know, the land stayed in the family and you just continued to take over. You could see conditions become that again, where it's like, well, this is just how I'm going to pass on my wealth. I'm going to hold this, stay in one place, and kids, you can take the house. It's worth, you know, by the time you're old, this $200,000 once $200,000 house could be worth $5 million after inflation over the course of 75 years. So here's just hold on to
Yeah,
this.
well, and that's true. I mean, it's amazing, the prices of houses. I mean, you know, it's kind of painful, but my wife and I kind of watch some of our former houses and what they've done price wise.
Yeah.
And it's like, oh my goodness, like think if we had that house today, type of thing, where they're being bought and sold for astronomical amounts, or in our eyes, astronomical amounts, way more than what we paid for them and way more than what we sold them for. So
You could see a scenario too where if this went on long enough, where you see equity built even faster than what we've normally seen. Before, equity was only built by big movements in the real estate market or slow movements in it
right,
if you wanted to give it time. But nobody sat and paid off their loan for very long because everybody was moving and refinancing every 35 seconds, and that sets you back every single time you do that. Well, the refinance market's dead. Right, I mean, nobody's out there doing that, may unless you're in a higher loan
right,
and you're hoping to refinance, nobody's doing that, and if everybody's
right,
sitting on 3 and 4% forever, everybody's just paying down their loan.
correct,
Loans just go away. I mean, maybe
right.
this is gonna force
People,
everybody into a
yeah.
better financial condition.
Well, yeah, it used to be that people would hold their houses for, like our grandparents' generation, that they would hold their house until they paid it off and continue to hold the house even after they paid it off.
Yeah,
And that changed, with partly with our parents' generation, and then definitely with our generation. Like, even you and I mean, we could probably count. It takes at least two hands to count the number of homes we've
oh,
owned.
yeah.
And so the idea of being more transient, like, oh, okay, well, I'm just going to sell this house and move on or whatever. Now it's almost shifted back where people are like, no, I'm keeping this thing as long as I can because I got this golden ticket, I got this interest rate. Well, like, why would I ever sell this thing?
Yeah. Interesting.
Yeah, it's forcing people to almost build wealth when before they weren't.
Yeah, I mean, fast forward 10 years. You don't have to go that far, and all of a sudden and people are still sitting on 3 and 4% mortgages because it hasn't dropped down. You could have I mean, think about how many more people are in such a better equity position after 10 years of paying down loans with, with that. That's an interesting dynamic.
Well, and it's cheaper than rent. I mean, if you have a house that you bought, you know, 6, 7 years ago with one of those, and you refinance maybe into, like a 2.83% loan.
Mhm.
I mean, you can't rent in your neighborhood for
No.
for less. It's significantly more expensive to rent. So you're going to stay in that house. You're going to keep that house. You're going to pay off that mortgage. So actually, you bring up a good point that I wasn't even thinking about, which is this is forcing people that otherwise wouldn't be doing it to build wealth that they
Yes,
wouldn't otherwise.
I think so. I think so. You could
Yeah,
you could theoretically, just because of forced market conditions in 10, 15 years, because a huge part of the interest is paid early on these loans, but, if people
right.
end up just sitting on you've got all of a sudden just people forced into better economic conditions. They'll have a lot more equity and maybe just a lot more homes paid off and a lot more wealth built. Um, I mean, I
Mm,
right now, like, I could with mine, before I would ever sell it, I would rather just find a renter who
right.
could continue to pay down my w whatever
Correct.
mortgage it is, and
Yeah.
then myself, if I wanted to move, just go try to find somebody who's gonna subto the deal and buy it from them that way.
Yeah.
That would be the way you would
Right.
ultimately wanna do it, and yeah.
That's exactly right. Yeah. I mean, this is very interesting. We're going to see a lot more paid off homes probably in 15, 20 years than we otherwise would
Yeah,
because
I
of
think
these low
so.
interest rate loans.
I
Yeah.
think so.
Mhm.
Alright, man, we're at an hour. Um,
Yep.
have a good evening, and if you're watching the show,
You
make sure to
too.
join us, next Tuesday, 5 Not 5. Next Tuesday at 10 a.m. for the
Yeah.
NREM podcast, and we'll see you next time for the Creative Finance Collective. We'll talk to you later.